Hello and welcome everybody. I am Sarah Cooke, your host at the Credit Union Connection. I'm here today with brand spanking new CEO of Happy Money, Matt Portere. Welcome.
Thanks, Sarah. Thanks for having me.
How did I do on that pronunciation?
You did well. You did really well.
Thank you. So you're new to Happy Money. Why don't you tell our audience a little bit about your background?
I've spent my whole career in consumer finance, in just about every consumer credit asset class, from personal loans to auto to mortgage, to credit card and small business. Most recently, before joining Happy Money, I was the CEO of a solar finance business, which I joined in 2015 as the sixth employee and took it public in 2021. We funded about $10 billion in loans. And nearly all of that through partnerships with credit unions. So it's a space I know really well.
That is awesome to hear that credit unions are working on, greening the planet with they're putting their money where their mouths are. How now you're into the personal loan
Mhm.
business, and talk a little about how that's different from what you've done in the past. Obviously, it's still consumer lending, but it's not an auto. It's not something with collateral. And then also, how does Happy Money do things a little differently from your competitors?
Interestingly, I was doing personal loans in the early 2000s, sort of before personal loans were a thing. When I was at MBNA, it was a $15 billion plus portfolio, and I was running risk for that business. So I certainly know unsecured personal loans. But I've done a lot of other things since then. If you look at my background, as I said, I've spent my whole career in consumer finance. And while people often call us a fintech, I really think of us as a consumer finance platform, which means that originating high quality assets in partnership with our capital partners, like our credit union partners, is really the foundation of our business. And I think that makes us a little bit different than some others in the market. We're really focused on originating assets with attractive risk adjusted returns.
Yeah, while offering it through a high-tech platform.
Exactly right.
So both big benefits for credit unions.
That's
Um,
right.
and so what are some of the benefits for offering personal loans to begin with?
Yeah, so first for the consumer gets an opportunity to consolidate their debt into a single payment and to save money over time. And so there's a real financial benefit and certainly convenience benefit by making one payment onto an affordable loan. For our credit union partners, they get access to a new member. They also get an asset with a great return profile for it, that's well underwritten. And as you mentioned, our tech platform makes that process easy and efficient for consumers, well underwritten, but in a simple process. So our credit union partners, you can almost think about it as they're plugging into Happy Money, and they're getting access to this volume. So they have no marketing spend. They're not building the tech infrastructure. And from a people perspective, it's a very light lift. And so we make it really simple for them to originate those assets.
That's really cool, because certainly credit unions' marketing budgets aren't always the biggest compared to a B of A or somebody like that around you. So how many credit unions, how many lenders are you working with? How many of those are credit unions?
Yeah, so we have about a dozen credit union partners, and today that's exclusively how we fund our business.
Mm.
Ethos of people helping people, and that really fits well what we do at Happy Money.
Oh, sweet. So 100%. So yeah, I mean, right now, credit unions, their liquidity is tight. Consumers, their liquidity is tight. Um, uh, some can afford or may have issues paying back their loans. So how are you mitigating all that in times like these?
Yeah, so we're certainly, as I've mentioned a couple of times, really focused on risk and making sure that we're underwriting these loans appropriately, and not just underwriting them well, pricing them appropriately. We're focused on a high quality borrower. Our typical borrower, has a FICO score well into the 700s, although our credit strategy is more sophisticated than just FICO. Give you a sense, these are employed customers who with strong credit and strong income. And
Mhm.
we're really focused on those fundamentals, to make sure that the loan will perform well, through a cycle. Fortunately, the economy's been pretty strong, and hopefully consumers are going to get a little bit of relief now with some rate cuts, and I think that's also helping our partners' balance sheets. But we're really focused on through the cycle performance.
Yeah, yeah. And that you led perfectly into my next question. So, what is coming for lending as the rates are starting to trend downward and
Yeah.
liquidity is still tight, but it's, could very well loosen up, as you mentioned. And then we have an election coming up. And how will all that change
Yeah.
people's attitudes towards their money and their credit?
Well, we're finally at a different part of the cycle. So the focus, what we're hearing from our credit union partners is the focus is shifting. The last couple of years, balance sheets have been really tight for credit unions as well as for banks. And they've been really focused on how to manage that loan to deposit ratio. But now that we're starting to see the Fed cut rates and the pretty aggressive cut, the 50 basis point cut was on the high end of the expected range. We're recording this on October 1st, and Powell made some additional comments about today about expecting rates to continue on that downward trajectory. It changes the focus, and so our credit union partners now are shifting from a very tight balance sheet to how do I originate assets with a good return and start to think about growth again. And so they're starting to think about getting in front of it, especially when many of them are overweight in direct auto,
Mhm.
which is having spent some time in the auto business, is a tough business. Those margins are tight. There's nothing proprietary about it. And that's a tough asset to originate. And so many of them are thinking about diversifying and getting some other assets on their balance sheet.
Yeah, and you make a good point too about the auto lending, indirect auto lending, kind of being similar. One of the problems or one of the challenges credit unions face with those is making those members more complete members, not just having an auto loan and walking away. Do you all work on that at Happy Money as well?
Yeah, so certainly if well, there are two ways that a credit union can partner with us.
Okay.
One is through direct originations, where we memberize the borrower. They become a member of the credit union, and it increases the number of members for our partners. And some credit unions prefer to start off with participations, and so they'll own a piece of the loan. They won't own the whole loan. And in that case, they don't get the member; they get just the asset itself. But if you look at the profile of the member that we're bringing on, tends to be a significantly younger demographic than the typical credit union partner. So it really sets it up for a good long-term relationship. We never like to promise that there'll be a certain amount of cross-selling, but what we do say is it'll be a new member that fits a good profile, and the loan itself and the asset will have an attractive return profile.
Well, in addition to the asset itself, having those younger members is really important for credit
Right.
unions that are averaging 53 years old for their average membership or member.
That's
So,
exactly right.
do you know the average age of the people who are taking out the personal loans?
Yeah, typical our typical customer member is around 40, give or
Hmm.
take a couple of years. So yeah, significantly younger, tends to be a significantly younger demographic, which makes sense if you think about the profile for helping consumers consolidate their debt, and they're doing it online through a fully digital process. It tends to skew to a bit of a younger demographic.
Right. And then you said also they still have good credit scores though, because you tend to think of younger
That's right.
people maybe not having much of a credit score at all.
That's right. Now, of course, we don't discriminate on the basis of age, but it tends to not be a very young, a very young consumer. The typical loan is about $20,000. So you think, that consumer needed to have good credit and be able to get over $20,000 in credit lines available to them so that they can consolidate it. And I mentioned some of the demographics of the
Mhm.
customer and the credit profile. So it is a strong borrower for sure.
Hmm. Okay, and so with these videos, I always offer my guests the final thoughts. So Matt, what say you? Anything we missed? Anything you want to just close out on?
Yeah, so this is a unique time. We mentioned that the Fed is finally starting to cut rates, and our credit union partners are getting the opportunity to start to think about growth, which is a little bit more fun. and diversifying their balance sheet. And so at Happy Money, those credit union partnerships are the cornerstone of our business. And we really appreciate the partnerships, and of course are looking to grow along with our partners, new and existing.
Yep. Yep. Cheers to fun. Cheers to the fun times. All right. Thank you so much for your time, Matt. I appreciate it.
Thanks for having me.